In this video, I'll be doing a weekly analysis showing you how I forecast the market and how you can apply the same approach on your own as well. Before we move to the chart, I want to show you two key concepts that will help you understand where the market is most likely to head to next. The concept we are going to talk about is the concept of candle science. Now, what is candle science? Candle science simply refers to understanding the behavior and intention behind each individual candle. But for this lesson, there are four specific candles I want us to focus on, and these are the four. Now, the first two are bullish signals, while the last two are bearish signals. Let's break them down one by one and look at each candle formation individually. Here's the first one. As you can see, price swept the previous candle's low and closed with a wick. When this happens, our target becomes the most recent candle's high, which is this one, and the previous candle's high, which is this one. Whenever you see this type of formation, especially on the higher time frame, it suggests that the market is most likely turning bullish. Now here's another bullish example. In this case, price closed above the previous candle's high. This shows a clear bullish intent. From here, we should be targeting either the previous candle's high, which is here, or any draw on liquidity above price. Now let's look at some bearish examples. In this example, you can clearly see that price closed below the previous candle's low. Once you see this, it is a strong bearish signal. Immediately, the most recent candle's low becomes our next draw on liquidity, followed by other liquidity pools sitting below price. Now here's the last one, which looks very similar to the one in the bullish example. It shows a clear previous high sweep. When this happens, we know the market is most likely turning bearish. So our first draw on liquidity would be the recent candle's low, and our other draws on liquidity would be the previous candle's low and any other draw on liquidity below price. The next concept I want us to look at is the idea of internal range liquidity and external range liquidity. In this context, our internal range liquidity refers to the fair value gap, while our external range liquidity refers to previous highs and previous lows. When price is sitting at an internal range liquidity, the next draw on liquidity is almost always an external range liquidity. Conversely, when price is positioned at an external range liquidity, the next draw on liquidity will most likely be an internal range liquidity. Honestly, this is the core of what you need to understand about the relationship between internal and external liquidity. Simply identify which one price has tapped into or taken out, and you'll immediately know where price is likely to target next. Now that we understand these two concepts, let's move to the chart so I can show you exactly how I use them to forecast where the market is likely to go this week. So, we'll start with the DXY chart, because once you know what the DXY is doing, you most likely know what the other dollar pairs will also do for the coming week. On the monthly chart, the first thing I can see is the concept of internal range liquidity to external range liquidity. Right now, we can clearly see that price is sitting inside an internal range liquidity, so our next draw on liquidity would be this external range liquidity. This is what we should expect in the coming months for DXY. Now let's go to the weekly chart and see what the market is doing. On the weekly chart, we can also see the concept of candle science. As we can see, price closed below last week's candle. Since price closed below this candle, it tells us that this candle's low will most likely be our next draw on liquidity. So despite price being in a monthly bullish fair value gap on DXY, it still has the possibility of dropping down, taking out this low before pushing to the upside. Now heading to the daily chart, we can clearly see the concept of internal range liquidity to external range liquidity, and also the concept of candle science playing out together. Here, our internal range liquidity is this fair value gap. So we are anticipating price to move from internal range liquidity to external range liquidity. That means on the daily chart, we are currently bearish. So now we have this. The monthly is bullish, but the weekly is bearish, and the daily is also bearish for now. On the daily chart, we don't just have the fair value gap, we also have candle science. Looking at the previous two candles, we can see a sweep of the previous candle's high. This clearly shows us that this week, price will most likely target this low here and also this low here. These are the two main areas we should be looking for price to reach. And when price gets to these levels, then we can begin to look for signs of whether price wants to go up or continue pushing down. But right now, I am bearish on DXY for this week until price takes out these lows. Now let's move to the next pair, which is EURUSD. I'll also show you how I apply the same approach here. On the monthly chart, we don't have much to work with because the candle hasn't closed yet. So let's start with the weekly chart. On the weekly chart, when we zoom in slightly, the first thing we're going to notice is candle science. Here, we can see that last week's candle closed above the previous week's high. Since we know this, according to candle science, this high becomes our first draw on liquidity. After price taps this draw on liquidity, we can then start targeting other swing highs. But for this week on euro to US dollar, this weekly high will be our primary draw on liquidity. Now moving to the daily chart, since we already know the weekly is showing a bullish signal, we want to see whether the daily chart agrees with it. And here on the daily, we see the concept of internal range liquidity to external range liquidity. This fair value gap here is our internal range liquidity. Since price is now sitting inside that internal range liquidity, our next draw becomes the external range liquidity. So we now have the weekly bullish and the daily bullish. When your higher time frames align this well, there's a very high probability of getting clean setups for the week. Now let's talk about GBPUSD, and you'll see something very similar. First, on the weekly chart, we can see that price closed above the previous candle's high. This makes that high our draw on liquidity. Again, the concept of candle science. Now heading to the daily chart, we can see that we also have a daily fair value gap, which again brings in the concept of internal range liquidity to external range liquidity. This is the fair value gap we have. Because of this, there is a high possibility that price will push to the upside next week. And not only that, when we remove this, we can also see candle science playing out. Here, price swept the previous week's low. Because of this sweep, this high and this high becomes our draw on liquidity for the week. If you want the PDF version of this video, click the first link in the description. If you found this video helpful and insightful, give it a thumbs up and subscribe. See you in the next one.